Hey everybody, it is Boz, and we are going to take you through lesson 4, completing the accounting cycle. Well, as we get into this one, we're going to identify the steps in the accounting cycle, create an unadjusted trial balance from the T accounts, determine 4 types of adjusting journal entries, prepare an adjusted trial balance and financial statements, and then complete the closing entries. I wanted to start first with an example, and this is Salesforce. Salesforce is a cloud-based company, provides customer relationship management platform, and just helps consult with companies and figure out who their customers are and what sort of metrics they can track with them. So if we look at the balance sheet for Salesforce, what sort of accounts within this might give rise to adjusting entries. We have the last couple of years of their balance sheet here. Where might we need to look and see that revenues or expenses needed to be updated at the end of the accounting period? Well, most of these accounts are actually going to require that, but just a few examples for us here. We're going to want to make sure that we look at the first account here, accounts receivable, just trying to figure out if there's some billings that need to be done for services we've performed but have not yet collected the cash for. We're going to be looking at the next one, property and equipment. Maybe we need to reduce that through depreciation. We're going to be looking at accounts payable, accrued expenses, other liabilities. Accrued expenses are a huge area. One of the big areas within that is going to be accrued wages. We're going to want to look at unearned revenue to see if some of that has been earned. And then we're going to want to look at debt accounts to see if there should be some interest expense accrued on those debt accounts. Now, this is a final balance sheet for Salesforce, so all the adjusting entries would already be done in here. But those are just a few of the accounts and certain things that we would be looking at to make adjusting entries for. Well, identifying the steps in the accounting cycle here, we're going to start with preparing journal entries and post them into T accounts. If you've been following along through lessons 2 and 3, that was really the focus of those. And then now here in lesson 4, we're going to prepare an unadjusted trial balance. We're going to make adjusting entries, then prepare an adjusted trial balance. We'll then prepare financial statements and then close out revenues and expenses to help us get to a post-closing trial balance. So those are kind of the steps that we're going to go through. And that first step, again, is really the one that we've done so far in lessons 2 and 3. All the rest we're going to show you how to do today. So which of these is not a step in the accounting cycle? You could take a minute, pause the video, or just think about this. Which one of these is not going to be a step in the accounting cycle? Well, if we want to get back and look at this, then prepare a post-closing trial balance. That is a step. It's the final step in the accounting cycle. Financial statements are, of course, a key step. That's basically the reason why accounting is done, is to prepare financial statements, and that's going to be done after the adjusted trial balance has been prepared. Journal entries is the first step, and then the incorrect answer, we don't close out adjusting entries. They're prepared, they're not closed out. It's the adjusting trial balance are the amounts that are going to get closed out. Go ahead and onto the next section here. Create an unadjusted trial balance from T accounts. Well, in lessons 2 and 3, we learned a lot about how to prepare journal entries and post them into T accounts. And if there's already balances in the T accounts, because you're done with that, it's pretty easy just to transfer them to an unadjusted trial balance. Companies might use debit and credit columns. Just look at the balances in the T accounts. If it's a debit, put it in the debit column. A credit, put it in the credit column. Some companies also use a one-column approach to show debits as positive numbers and credits as negative. Optimally, you would list the accounts in the order how they're going to be presented on the financial statements, just to make it very easy for them to prepare afterwards, and make sure to check that debits equal credits. So here is an example. We're going to use this sample company throughout. So we're going to say that a company has been around for a while, and these are its T accounts. And these are the balances in the T accounts after the regular journal entries have been done. We then will just take those balances and put those into an unadjusted trial balance. You can see Debits go in a debits column on the left, credits in a credit column on the right. And we see that debits equal credits at the bottom. Now, if I wanted to show that in a one column approach, this is the same information. It's just one column approach. Debits are positive numbers, credits are negative, and then it zeroes out at the end. And that's the way to tell that debits equal credits. In my experience, I think more companies actually use this approach right here. Debits positive and credits negative. But I think this pictorially is easier to understand as you're trying to just understand the financial accounting process. So that's why I'm usually going to teach it using this approach, the debit and credit columns separate, although practically this is probably a little bit more common. So, which one of these is a principle of creating an unadjusted trial balance? So do this review question and, which one of these is correct here when you're doing the unadjusted trial balance? You could pause it for a minute or just think on it. Well, if we look at them, assets should equal liabilities plus shareholders' equity. That's absolutely true, but we can't easily see that by looking at the unadjusted trial balance. Debits are listed as negative numbers. That's incorrect. They're either going to be in a separate column, or if they use a single column approach, it's going to be the credits that are going to be negative numbers. Net income, it will be computed, but that's not the purpose of the adjusted trial balance, and you can't easily do that just by looking at it. Total debits should equal total credits. Absolutely. Two column approach, they should equal. In a one column approach, the balance should end up to be zero. The next section is really the meat of lesson 4. The adjusting journal entries. These are the most complex thing that we've done this far. I think financial accounting levels off after this point. This is kind of the big crux and one of the most difficult parts to understand in the accounting cycle. And then after this, you're mainly through the accounting cycle. You'll see what comes after this is pretty straightforward. And so if we can get through this, then we understand the whole cycle, and then we can just dive into learning about some specialized topics in future lessons. Well, there's 4 types of adjusting entries. There's both accruals and deferrals, and within each of those, there's revenues and expenses. So there's an accrued revenue. Basically means that a company has earned revenue before it got cash. There's deferred revenue, basically meaning that a company got cash before earning the revenue. There's accrued expenses, meaning that a company incurred an expense before it paid the cash. And there's deferred expenses, the company paid the cash before incurring the expense. So we're going to dive into examples within each of these, and we're going to build off of that unadjusted trial balance that we looked at just a couple minutes ago. So let's say this same company provides $1,000, and we'll be looking at a December year end here. The company provides $1,000 worth of services to a client during December. It doesn't invoice the client to receive payment until after the end of the year, maybe January. What are the journal entries? Well, we come to the end of the month and we're like, is there any revenue that we need to accrue, revenue that we've earned that we haven't recorded yet? And, sometimes when you earn the revenue, and the important point here I say is that they didn't invoice the client. Oftentimes that invoicing of the client will trigger a journal entry. But if you don't invoice the client, you got to do this at the end of the period. You need to debit accounts receivable and credit revenue. All right. Now, certainly, if you send an invoice to the client during the month and you record this entry, you don't do it again at the end of the month. That would be double counting. But the point here is that you get to the end of the month. If you've earned revenue and you haven't recorded it yet, you need to do it through this entry right here because you've earned it. And then next month or whenever the company gets payment, it's going to debit cash and then credit that accounts receivable to get rid of it. So the combination of these entries here will end up to be an increase to cash and an increase to revenue, but we don't just do them when we receive the cash because we want to put the revenue in the period that we earned it. The next example here is going to be into deferred revenue. So let's say that a company got paid on December 1st by a client for services that were going to be performed sometime later. And maybe it was agreed that it was going to be later that month, or maybe it wasn't even agreed when they were going to be. It was just going to be some time later. What the point is the moment that company got the cash, it hadn't done anything to earn it yet. All right. So when it got the cash, it needs to record the cash, right? It needs to debit the cash, but then it also needs to credit something. It's not going to credit a revenue account here. It's going to credit unearned revenue, which is a liability because the company has a liability. It owes the client some services. And if it decides not to perform services for the client, it's going to owe the client their money back. Now, ultimately, when you have unearned revenue, this can be a tough one because when you go off and perform the services in a big organization, the accountants don't necessarily know that people are out there performing services. So they need to communicate with people at the end of the month, and they'll say, okay, what sort of services have we provided? All right, that are out there that we had previously gotten paid for. And then the folks on the operations level will say, yeah, we perform these services for this client. And the accountants will jump in and say, okay, well, now that we've performed them, we can get rid of the liability by debiting it. And now we can actually credit the revenue because we've earned it. So that adjusting entry can be complex again because there's nothing that necessarily triggers it. The accountants have to have a good process in place to work with the sales team and the folks on the operations side of it to figure out when these services have been provided. Well, let's go into an accrued expense in the first example here. Let's say a company basically has $1,000 of wages expense every day, and every 2 weeks people work 10 days, so they got 10 grand of wages expense. Let's say it gets to the end of the month, the end of the December, and the employees had worked 7 days. All right, and maybe the other 3 days, the employees are getting paid every 2 week period. The other 3 days are coming in January. All right. So they've earned $7,000. And because the employees have earned it, that means that we have a liability to them. And we record that liability by debiting wages expense and then crediting the wages payable liability account. All right. The accounting team has to do that at the end of the month. They have to look into this and say, okay, what amounts have our employees earned that we haven't yet paid them? Because this is truly a liability of ours at the end of the month. And then when we ultimately pay the employees next month, so here's the thing on this one, is that we're going to get rid of that wages payable when we pay them. Now, we pay them every 2 weeks. So now they're going to work the extra 3 days. If you look up above it, it said that they get paid every 10 grand every 10 business days. In December, they'd worked 7 days. So now they work the remaining 3 days in January. We record that expense and then we pay them the whole $10,000. All right, that is one example of an accrued expense. Another example of an accrued expense, this one's a little bit longer here. I wanted to do it as it relates to a loan. All right, so let's say that this company takes out a 1-year $10,000 loan on December 1st. It's got a 6% annual interest rate, and interest is due at the end of the loan. What are the journal entries? Well, on December 1st of year one, it's going to be pretty simple. The company gets cash and it has a liability to the bank. All right, debit cash, credit notes payable. Now what happens is we get to December 31st. All right, we don't make any interest payments. We don't make any principal payments, but this loan has been outstanding for a month. So we now owe the bank some interest. We are not going to pay that interest until December 1st of year 2. But the liability has started to accrue. So we need to record some interest expense December 31st of year 1. The computation is the principal amount of the loan is $10,000. The annual interest rate is 6%. And the time the loan was outstanding, it wasn't outstanding the whole year. So we can't just do 10,000 times 6%. That would be $600. All right. It was only outstanding for a month. So that's where we record interest expense of 50. We don't pay it, so we don't credit cash. We have a liability to the bank. A liability is done through a payable here, interest payable. Now we get to, and that should actually say that December 1st right there, but December 1st of year 2, and we're going to get rid of those notes payable. we are going to get rid of the interest payable. Okay, so we're gonna satisfy everything. And now we have the remaining interest. 10,000 times 6%. That one should say 11/12 right there. Sorry about that. But should say 11/12 right there. And the remaining interest expense will get recorded in year 2, and then we will credit cash for that whole amount. What is that? We're paying back 10 grand of the note, and we're also paying $600 of interest, but we don't record the full 600 of interest in year 2, because the reason we owe interest is because it was outstanding each and every month, each and every day, actually. So we want to show 1 month of the interest in year 1 because it was outstanding for a month in year 1. And then it's December 1st of year 2, 11 months in year 2. The deferred expense. So if we go on to one of these examples here, let's say that on December 1st, a company pays rent for 6 months in advance. The total rent paid for the 6 months, it's $1,000 per month, so $6,000. Well, the entry on December 1st, we think about that one. All right, this is going to be a debit to a prepaid rent expense account. All right, and we're going to credit cash. We are not merely going to debit rent expense yet, because we haven't used the space. It's the actual using of the space that is going to create an expense. We think about that, like immediately. Let's say December 2nd, we're like, wow, we shouldn't have done that. We no longer have a need for it. Chances are you could call up the landlord and say, you know what, I really don't need that space. Can I get my money back? And the landlord would either give you, all the money back, or probably a large chunk of it, right? Or you could, kind of sublease the space onto to someone else. But the key here is that prepaid rent expense. You would think it's an expense account that goes on the income statement. The word prepaid overrides that. This is an asset account. Prepaid rent expense is an asset. Now, at the end of December, then we are going to record some rent expense. Why? Because we have used up 1 month of that prepaid rent expense asset account. All right. And we would actually repeat this 6 times until it was gone. And at the end of the 6 months, then we would have 6 grand of rent expense. We would have paid 6 grand of cash, and that prepaid rent expense asset account would be gone. But we don't just record it all right away. Why? Because we want to record it in the period when we use up that asset. All right. The next review question here. Let's say that wages earned by employees but not yet paid. What type of adjusting entry are they? You can take a look at this one for a minute. You can pause it if you want. But what type of adjusting entry is wages earned but not yet paid? All right, well, you can see that accrued revenue was incorrect. That's when revenues have been earned by the company and cash has not yet been received. Deferred expense is not correct. And that happens when cash is paid by the company before the expense is incurred. Deferred revenue is not correct. That occurs when cash is received by the company, but they haven't earned the revenues. Accrued expense is correct. All right, because the employees, they're separate from the company, have earned that money. We have incurred the expense. All right, we've incurred this expense. We haven't paid it. We need to accrue the expense. Well, those right there, we went through that in a few minutes. Real world, that stuff takes a lot of time. Some of those amounts that we compute are very difficult, but that's a high-level snapshot of how we do it. So now we can take those amounts and we can create an adjusted trial balance from those. So we look at this right here. Now we not only have the adjusted trial balance, and that's what we showed before, all right, but we also have our adjustments in here. And the unadjusted trial balance, we make the adjustments equals the adjusted trial balance. You can see cash, there was no adjustment made. We never adjust cash, all right? Some tips I have for you. We never adjust cash, and we always adjust one revenue and one expense, and then we also will make the offset to an asset or a liability. All right, but you can see accounts receivable. All right, if we look at those, there was an adjustment made. So we started with accounts receivable unadjusted of 12,000. There was an adjustment of 1,000, so they increased to 13,000. Prepaid rent expense started with 6,000. It decreased through a credit by 1,000, and it's left with 5,000 at the end. So we create an adjusted trial balance, and then with that, we create the income statement. All right. So if you go and this is in order, usually companies will start with assets first. This is ordered very typical here. It goes assets, then liabilities, then equity, then revenues, then the expenses. Even though you'll first create the income statements, you kind of got to go to the bottom of your trial balance and pull in your revenues, your expenses, and take off the expenses, and then that will give you net income. The statement of retained earnings. We have our beginning retained earnings. All right, so we can see the 8,000 in the unadjusted column, and then the net income from the income statement flows into the statement of retained earnings to leave the ending balance at 9,950. We then create the balance sheet. All right, you can just see we're just pulling those asset amounts from the adjusted trial balance, and then when we get to liabilities and equity, we need to make sure to flow the ending retained earnings down into the equity section of the balance sheet. And we've got a balance sheet with total assets equaling total liabilities plus equity. So in which order are financial statements prepared? You can pause the video if you want for a minute. You can think about this one, but in what order are financials prepared? Well, it's not the balance sheet first, all right? It's actually last because it needs information from the statement of retained earnings, which needs information from the income statement. It's not income statement, then balance sheet, and then statement of retained earnings because the balance sheet needs information from the statement of retained earnings. So yes, the income statement's first, but statement of retained earnings is next. It's not statement of retained earnings first because it needs information from the income statement. It is income statement first because you'll compute net income, which will flow into the statement of retained earnings, which will flow into ending retained earnings on the balance sheet. Well, when you get to this point, you're mainly done. You prepare your financial statements, and it seems like it seems like you're mainly done, right? And you almost are. And you just need to create, complete closing entries so everything is ready to rock and roll, ready to go next period. So the closing entries, the theory behind them. A company needs to close certain accounts so that they may begin at zero next period. Which accounts? We are going to close our income statement accounts. Why? Because an income statement covers a period of time. Every year starts over. A balance sheet covers a point in time. A point in time doesn't start over. To help illustrate that, I pulled the last year of Chipotle's financial statements. In 2022, it had 8.6 billion of revenue, and at the end of the year, it had 384 million of cash. All right. One day later, January 1st, 2023, it starts over. It doesn't have any revenues until the first person shows up on January 1st. So it starts with zero, but it's not like their cash disappeared. All right. That cash is all still there. So that's why we close out income statement and not balance sheet accounts. The process, revenues are going to be debited. They normally have credit balances, so to get rid of them, we debited, and then we are going to credit retained earnings. Expenses are going to normally have debit balances, so we're going to credit those, and we are going to close those with debits to retained earnings. So what that does, when we say doing our credits and our debits to retained earnings, we zero out the net income, and it moves it into retained earnings. Because it's not like the income statement results are forgotten, right? I mean, that happened in a year for a company. We just need to shift it into retained earnings. Remember, retained earnings is the accumulation of all prior period earnings of the company minus any dividends that it paid out. So the example for our sample company, we had 38,000 of wages expense. We had 38,000 of revenues, and then there were three expenses: wages of 24,000, rent of 12,000, and interest expense of 50. What are the closing entries? Well, we usually look at them separately. So we're going to debit revenue to get rid of it, and then credit retained earnings. And then for the expenses, we are going to credit them to get rid of them. All right, each of them individually, and then debit retained earnings for that sum amount. And if you look at, the retained earnings right there, we credit retained earnings for 38 grand. We debit it for 36,050. That basically is 1950. That was the net income we computed, was 1950. So that's where we're transferring net income of that 1950. Again, the difference between 38,000 and 36,050, 1950 of net income now goes into retained earnings. And now we've got our post-closing trial balance. We've just been building on this the whole time. We've got our unadjusted, our adjustments, our adjusted trial balance. And now we put in there our closing entries, and there's our post-closing trial balance. You'll notice that the balance sheet accounts are all still there. The retained earnings has gone up by 1950. This is not a brand new company, right? We're assuming this has been in existence for at least prior months, maybe prior years. So retained earnings, started at 8,000 and it went up to 9,950. So that was their net income of 1950. And then you'll notice all the income statement accounts are now zero. They're ready to reset and start next period. So we think about which account would not be impacted by closing entries. You can go ahead and take your guess on this one if you like. Pause the video if you want. COGS is incorrect. That's an expense. We're going to credit it to get it to zero. All right. Retained earnings is incorrect. Revenues and expenses are closed to retained earnings. So in fact, retained earnings is the only balance sheet account that's going to be affected by closing entries. Revenues is not correct. We're going to debit those to get revenues to zero. Cash is correct. Cash is a balance sheet account, which is unaffected by closing entries. Well, to be with you in lesson 4 here today, steps in the accounting cycle, prepare the journal entries, prepare the unadjusted trial balance, make your adjusting entries to get you to the adjusted trial balance, prepare the financial statements, then close out your revenues and expenses to prepare your post-closing trial balance. And remember, there's 4 types of adjusting entries, which are going to require a lot of your time: accrued revenues, deferred revenues, accrued expenses, and deferred expenses. That's what we got for today. Thanks for being with everyone.